Every boom begins with a promise. This time is different. This time, the rules have changed. This time, we've learned from the past. And every time, history just smiles quietly because it has heard this all before. From the outside, economic booms look like pure progress. Cities rise from the ground, skylines are redrawn, markets surge to new heights. Confidence spreads like a wildfire, touching everyone. That old enemy suddenly feels manageable, even tame. Wealth, once a distant dream, now seems inevitable. But beneath this shimmering surface of optimism, something far more fragile is taking shape, an illusion of permanence in a world that is always, and will always, move in cycles. The paradox is deceptively simple. The very same forces that create the dizzying heights of a boom are the exact same forces that guarantee its eventual, often spectacular collapse. To truly understand why every boom seems to end in the same kind of crash, we can't start with spreadsheets and complex financial models. We have to start with something far more fundamental: human behavior. For as long as markets have existed, so have these cycles of hope and despair. This isn't a modern invention. Ancient Rome experienced massive credit bubbles fueled by land speculation, ending in financial ruin for many. Renaissance Italy saw powerful banking dynasties rise and then crumble, sending shockwaves through its interconnected city-states. Of course, there's the famous Dutch Tulip Mania of the 17th century. It became the textbook example, the first widely recorded speculative bubble. It was never really about the tulips. They didn't inherently matter. What mattered was belief. Belief is the engine. When prices start to rise, confidence follows closely behind. As that confidence grows, caution begins to fade into the background. People who were once prudent become bold. Risk, once carefully weighed, becomes invisible or worse. It's openly mocked. The skeptics, the voices of reason who warn of overheating, are dismissed as outdated, as people who just don't get it. Regulators, caught between public pressure and the powerful momentum of the market, hesitate to intervene. And innovation, the very engine of progress, becomes an all-purpose excuse. This time is different, they say, because of this new technology, this new paradigm. By the time the danger becomes obvious to everyone, it's already deeply embedded in the system, like a virus that has already spread. The Industrial Revolution didn't break this pattern, it accelerated it. Railways, steel, electricity, incredible breakthrough promised a new, permanent era of prosperity. Capital rushed in, desperate not to miss out. Leverage, the ability to borrow and invest far beyond one's means, expanded dramatically. Fortunes were made with breathtaking speed, and they were lost even faster. The cycle didn't disappear, just refined itself, becoming faster, bigger, and more dramatic. By the 20th century, modern finance added a whole new layer of complexity to the mix. Credit markets, once relatively simple, became vast and interconnected global networks. Central banks emerged with the mandate to manage economies and prevent financial chaos. Governments learned how to stabilize downturns with stimulus and support, but in doing so, they also learned how to unintentionally inflate booms, pumping them with the very fuel they were trying to control. The Great Depression was supposed to be the ultimate lesson, the crash to end all crashes. It was a scar so deep on the collective psyche that it was meant to ensure we would never, ever let it happen again. Instead of teaching us how to eliminate risk entirely, it taught policymakers how to soften the pain of a fall. It taught them how to manage the symptoms, not cure the underlying condition. After World War II, the global economy surged. A long period of stability returned. Financial systems were rebuilt to be safer. Regulation was tightened. The memories of the 1930s were still fresh, and over time, safety bred confidence, and confidence, as it always does, bred complacency. Slowly, painstakingly, the constraints began to loosen. The guardrails were quietly dismantled, one by one. The credit became easier to get. Financial innovation, once again, promised greater efficiency and new ways to manage risk, often by simply hiding it in plain sight. Debt, both public and private, expanded quietly in the background. Asset prices, stocks, real estate, art climbed steadily year after year. Each individual step of this expansion looked perfectly rational when viewed in isolation. It only looked insane in hindsight. The pattern was repeating itself with almost mathematical precision. In the 1980s, deregulation and the belief in free markets fueled new booms in finance and corporate takeovers. In the 1990s, the dot-com revolution and the promise of the internet created another. In the 2000s, it was housing that became the center of gravity, the can't-lose asset that everyone believed would only go up. Each cycle had a different story, a different narrative, a different hero technology or sector. But the underlying structure was always the same: cheap money, rising leverage, and blind, unshakable confidence. And always there is a trigger. Crashes rarely start where everyone is looking. They don't announce their arrival. They begin at the margins and the dark corners of the financial system, in overextended balance sheets of companies no one is watching, in complex financial products that nobody truly understands, or in a set of simple assumptions that quietly suddenly fail. When that trigger is finally pulled, confidence reverses far faster than it was ever built. Liquidity, the lifeblood of the market, vanishes in an instant. Prices, which seem to only go up, enter a free fall. Leverage, which multiplied gains on the way up, now magnifies losses on the way down with brutal efficiency. And panic, the most contagious human emotion, spreads from investor to investor, from bank to bank, from country to country. What felt so permanent, so solid just days before, reveals itself to be utterly fragile.
Ow.
But here's the uncomfortable truth. Crashes are not accidents. They are not random acts of nature. They are outcomes. They are the logical conclusion of a system that rewards short-term gains and encourages everyone to delay, thinking about long-term consequences. They emerge from institutions that have learned how to socialize the losses, letting the public bear the cost of a bailout while privatizing the profits during the good times. They are born from a web of incentives that consistently punishes caution and celebrates reckless speed. Booms convince entire societies that relentless growth is a permanent state of being, that the laws of economic gravity have been suspended just for them. Busts are the brutal reminders that growth is, and always has been, just a phase. And yet, after every single crash, when the dust settles and the damage is assessed, the same bewildered question is asked by politicians, by executives, by ordinary people: how did we not see this coming? The answer is always the same. We did. We just chose not to look. Have you ever noticed how economic crashes all feel the same? It's not a coincidence. It's part of the architecture of our modern economy. Let's break down why this keeps happening. It all starts with a boom. Once a boom gets going, it creates its own logic. Prices start to rise, and those rising prices become their own justification. Investors stop asking if an asset is actually valuable. Instead, they just assume it must be, because hey, everyone else seems to think so. But the financial models adapt, forecasts get adjusted upward, and the very definition of risk gets rewritten. This is how danger becomes invisible. The very heart of every modern boom isn't savings or productivity. It's credit. Borrowing money essentially pulls future growth into the present moment. It accelerates expansion, it supercharges returns, and it masks any underlying weaknesses in the economy. As long as asset prices are rising faster than the debt used to buy them, the whole system looks stable. But it isn't. Debt doesn't just disappear. It waits. Think about it. Banks are more willing to lend when the collateral, like real estate, looks strong and valuable. Households borrow more when they feel optimistic about the future. Corporations take on debt to leverage their balance sheets and boost their earnings. And governments, they tend to tolerate it all because the economic growth numbers look healthy. This creates a powerful feedback loop that just gets tighter and tighter. Then comes financial innovation, which deepens the illusion of safety. We get new, complex instruments that are supposed to spread risk around, but they also obscure it. Things like derivatives, securitization, and structured products all promise safety through complexity. Very few people truly understand how they work, but everyone trusts the math behind them, until of course the math stops working. Every single major crash follows this exact script. In 1929, it was leverage amplifying stock market speculation far beyond economic reality. In 1987, it was automated trading systems that accelerated a panic. In 2000, it was dot-com expectations outpacing actual earnings. And in 2008, It was housing debt that became a systemic threat to the entire global financial system. Different assets, same mechanics. The moment confidence finally cracks, credit contracts. Lenders suddenly pull back. Borrowers are forced to sell assets just to survive. This selling pushes prices down, which triggers even more selling. Assets that once seemed totally liquid, easy to sell, suddenly become frozen. This isn't chaos. It's the structure of the boom unwinding itself in reverse. And that's when the central banks step in. They flood the system with liquidity, they slash interest rates, and they rescue major institutions. The primary goal is to restore stability, not necessarily to deliver justice. And for the most part, stability is achieved, but it comes at a cost. By cushioning the fall, these interventions preserve the system, including the very behaviors and incentives that caused the crash in the first place. The losses are socialized, absorbed collectively by society. The incentives for risky behavior remain unchanged. And before long, memory fades. The boom begins again. What makes these crashes feel identical isn't bad luck. It's the design. Modern economies are built to expand. Markets reward growth. Politicians depend on it to get re-elected. Investors demand it for their portfolios. So when growth slows down naturally, immense pressure builds to restart it artificially. This creates a deeply uncomfortable paradox. Preventing crashes in the short term actually increases their severity in the long term. Each bailout, each intervention, raises the baseline of acceptable risk for the next cycle. By the 2010s, this dynamic had reached an unprecedented scale. We saw interest rates hovering near zero for years on end. Asset prices, from stocks to real estate to crypto, soared across every single category. Global debt climbed to historic highs. Risk was no longer localized in one sector, was synchronized across the entire global system. The system had become incredibly efficient at just one thing: postponing the inevitable collapse. But postponement is not a resolution. When the next shock inevitably arrives, whether it's a spike in inflation, a geopolitical conflict, or a major supply disruption, the margin for error has shrunk to almost nothing. Small adjustments can trigger outsized, violent consequences. Volatility comes roaring back. And once again, confidence fractures. What changes from cycle to cycle is not the crash itself, but who pays the price for it. It's workers who lose their jobs. It's savers who see their purchasing power destroyed by inflation. It's the younger generations who inherit a mountain of debt. Meanwhile, asset holders, often protected by the very policies designed to stabilize the system, tend to recover much faster. With each cycle, this dynamic deepens inequality. Each crash leaves behind not just economic damage, but also deep social resentment and a loss of trust in our institutions. And still, the booms return. Why? Because the system isn't designed to learn from its mistakes. It's designed to function. And it functions best when everyone believes that this time, it's different. That this time, the crash won't come. After every crash, there's a pause. Markets find their footing. The raw panic fades into a dull ache. New regulations are announced with solemn promises. Reports are written, commissions investigate, and the language of finance gets an upgrade. Suddenly, everyone is talking about resilience, safeguards, macroprudential oversight. And for a brief, fleeting moment, it feels like this time is different. It feels like the cycle might finally, truly end, but it never does. The problem isn't that we don't know enough. It's that our incentives are fundamentally conflicted. Economic booms are a race, and they reward speed above all else. Crashes, on the other hand, punish restraint. Those who sound the alarm early are dismissed as pessimists, party poopers who just don't get it. Meanwhile, those who jump in late and ride the final, most dangerous wave are celebrated as geniuses. Our collective memory conveniently shortens, just enough for the same old risks to sneak back in, wearing a clever new disguise. What we call bubbles are often just a series of rational decisions made within a distorted system. Think about it. When interest rates are pinned to the floor for years, what's the incentive to save? You're being punished for it. When you see asset prices, stocks, real estate, crypto skyrocketing, staying on the sidelines stops feeling prudent and starts feeling like a threat to your financial survival. When debt is cheap, being cautious feels downright irresponsible. So individuals adapt. We behave rationally in an environment that has become fundamentally irrational. When the music finally stops, the blame gets pushed downward. It lands on the greedy speculators, the irresponsible homebuyers, the naive retail investors. But the underlying architecture, the system that created those incentives in the first place, remains untouched. This brings us to a crucial point. The most dangerous idea in all of finance is not greed, it's normalization. With each turn of the cycle, our expectations are reset, but always a little higher than before. Higher levels of corporate and government debt become the new acceptable standard. Larger and more dramatic interventions from central banks become routine, expected. Bigger and more complex financial institutions become untouchable. The very definition of too big to fail quietly, insidiously expands. Crashes stop being seen as catastrophic endings. They become features of the system, a predictable part of the landscape. Modern capitalism has become a master of recovery. It has a playbook for restarting growth after a crisis. It has completely failed at prevention. We know how to hit the gas pedal after a stall, but we have no idea how to responsibly tap the brakes when the economy is overheating. The result is a system that looks strong on the surface, but is profoundly fragile underneath. It's a skyscraper built on a shaky foundation, with each new floor adding more stress. Today, the signals are uncomfortably familiar. We see elevated asset valuations across the board. We see immense leverage, both public and private. The financial plumbing is more complex and interconnected than ever. The entire global system hinges on the credibility of a handful of central banks. Risk is no longer contained within one country or one market. It's globally synchronized. The specific details might differ from 2008 or 2000, but the underlying structure, it's remarkably similar. So what would it actually take to break this cycle? It wouldn't require a crystal ball to predict the future. It would require humility. It wouldn't require suppressing markets. It would require setting sensible limits. It wouldn't require more bailouts. It would require real, painful accountability. But these are hard sells. They are politically expensive. Pushing for more growth is always easier. Delaying the tough decisions is always more convenient. And selling a story of endless optimism is always more profitable. And so, the pattern continues. The next boom will feel just as exciting. The next crash will feel just as shocking. And afterwards, the commentators will line up to say that no one could have possibly seen it coming. All the while, history will just sit back and wait patiently, because every boom ends in the same kind of crash, not because we lack the data or the knowledge. It's because, when given the choice, we consistently prefer the comfort of the boom over the consequence of the bust. Until that fundamental preference changes, the real question isn't asterisk if asterisk the next crash is coming. The question is, who will be left holding the weight when it does? Thanks for watching. If this gave you something to think about, consider subscribing for more.